Okay, so we're recording the session so that you can review it later on. Okay. So basically, just a walkthrough of what this course is going to be about. This course is about risk management. It's a new course that's being required to BA students. And essentially, this course deals with risk insurance and risk management. You know. And why is it part of the curriculum for the BA program for the fourth year or for the senior students? Essentially, later we will realize, or part of our lesson, we will realize that the risk management is part of strategy management. At the end of the day, strategies are being crafted with the aim of trying to achieve organizational goals. But at the same time, in trying to achieve those organizational goals, there are impediments along the way, right? It's not 100% smooth sailing as you go and implement those projects and programs so that you can achieve your organization's objective. So this course gives you a critical and a integrative way of viewing risk, how it enhances value, how it enhances strategy, and how different kinds of risks have different kinds of risk controls or risk responses, which will allow you to achieve the goals of the organization. So essentially, that's what this course is all about. So it's a capstone course because you have to know everything already. Dapat nadaanan mo na yung HR, finance, operations, because here we'll be looking at risks related to those functions. No? And hopefully, by understanding risks better and understanding management of risks better, you're able to better uh, perform in your organizations, and you're better and you are more equipped to be able to achieve your organization's goals. Okay? Essentially, that's what this course is all about. Okay? So the description is this course is principles of risk management for individuals and organizations, the structure of the insurance industry, and financial aspects of insurance companies or markets. So we'll discuss later how we're going to study those components. Prerequisite is management science, because there's some quantitative aspects to this course, although we keep it to the most fundamental. Course credit is 3 units, scheduled Mondays 3 to 6 p.m. yan, not 4 to 6 p.m., sorry. And our LMS is UVLE. So you should be able to access UVLE already, and materials will be uploaded there. Okay. So learning outcomes, students should be able to demonstrate how business and society manage various types of risks. So you will expect to be exposed to different types of risks in this course and how to effectively manage them so that you can achieve your organization's objective. Also different categories, and I think very critical is how to approach risk management. And that's what we will be covering for the whole course. Okay. So how is the course structured? There are 3 modules. Okay. I will cover module 1, which is an introduction to risk management. So basically, we will be laying down the foundations of risk management. What are risks? What is enterprise risk management? Why is it important? Why is it critical? And how do you really do enterprise risk management? So we will set up the framework of how to manage risks in general. In module 2, with Dr. Suwan and Professor Yusuf, they will be discussing specific types of risk. So ganun din, you will undergo the risk management process, but having specific risks in mind. So how do you measure that risk? How do you treat that risk? How do you control that risk? So operational, project, financial, and liability risks. So these are the major components, but of course, there are different risks within each one. Okay. One requirement, which I'll discuss later, is the ERM process exercise, which is due October 18. I'll discuss that later. And the first exam is November 15. So I think this is during class hours, Monday rin to. Module 3 will cover insurance. So that will be covered by Dr. Ray. Okay, so a discussion on insurance markets, analysis of contracts, social and private insurance. And what's the role of insurance in the economy? And what's the role of the insurance in risk management? There will be case presentations at the end. No, and then there's a second exam which will cover insurance basically. No, right? So that's the coverage. So if you look at course requirements, there are two exams. The ERM process exercise is an exercise, no, wherein you will undergo the ERM process or enterprise risk management process. So this is the parang capstone requirement of module 1, okay, is to submit that ERM process exercise. That requirement will be by group. So your groups have been assigned by Dr. Yusuf, Professor Yusuf, in UVLE. So you should be able to see those pre-assigned groupings already. Okay. There's a case presentation wherein you're supposed to present the risks of an organization and how it should be managed. So the guidelines for that will be released on October 4. So the release of case guidelines will be on the last day of my module, or if not the last day of my module, the first day of the module of Dr. Suwan and Professor Yusuf, module 2. And then there will be discussion forums in UVLE, and it's not required, but active participation will give you a merit of 5% additional bonus in the first exam. So, so Ma'am Ivy, Al, and myself will decide on the bonus since it will cover our section, which is the first exam. Okay. So I'll be posting some topics from time to time, so you're encouraged to participate in those forums. And of course, if you want to merit the 5% bonus or want to get the 5% bonus, you have to actively participate. Okay. References. These are the references for the whole course. Each of the professors will provide their detailed reference during their section. Okay. So for example, in my section, I don't use all of these books, and I'll let you know which ones I use in my section. And that's what Dr. Suwan will do and Dr. Ray will do their respective sections. But in general, these are the three references that we will use. There will also be Philippine cases and certain laws specifically related to insurance. So this is something that you will discuss with Dr. Ray. Okay. So that's it. So that's the whole syllabus. So so essentially for the first 3 sessions, you will be with me and we will finish this whole topic of introduction, and then I'll hand you over to Dr. Suwan and Al later on. Okay. Ma'am Ivy, you're here, right? And Ma'am Mia, are you already here, Ma'am? May mga words ba kayo na gustong sabihin?
Wala.
Enjoy!
And resume na. Okay. So for next week, what we'll do, for the third week, which is October 4, we go back to a synchronous session with the idea of like a live case discussion in class. And the idea is I'll give you some materials to read about Manila Water, what's the company about, and then let's try to simulate the ERM process as a big class. And hopefully I'll get some participation from you guys on that session. And then after which, your exam for my section is to submit an ERM process exercise. So I'll give you a case study to work on. Essentially, you will do the same simulation that we did for Manila Water in class. And that ERM process exercise will be submitted on October 18. Okay? And that is 15% of your grade. And that's my portion of the course. Okay? So that's it in terms of our coverage. All right? Sige, I'll go to the content na. So before we go to the main topics, the first section is what is risk and risk management. Let's try to, let's watch this video.
Hurricane Katrina, one of the most destructive natural disasters in U.S. history, wreaked damage worth $170 billion. That's an amount so staggering it dwarfs the annual economic output of most nations. Flooding alone destroyed 300,000 homes in New Orleans, while 19% of US oil production capacity was taken offline because of the 2005 hurricane season. This is just one example of how climate change not only has a human and
Oops, sorry.
environmental toll, but also a huge financial cost. One that economists say could lead to the world's next big financial crisis.
Climate change is the biggest challenge we face.
No one nation can solve this problem by itself.
And the worst thing would be if, people care about this issue. We have this goal, but 10 years from now, people can see that we're not really going to get the number down.
Fighting climate change has hit the mainstream, with many of the world's most prominent leaders speaking out. Yet, despite the sense of urgency, one common misconception is that we will need to trade a healthy economy and jobs for a sustainable planet. Is there any truth in that?
I think now there is an understanding that this has some risks. They also realize that they might face some financial losses if they don't do anything.
Yanis Dafermos has done extensive research on climate change and financial stability. He walked me through the two main reasons climate inaction could be a financial time bomb. There are the physical effects, such as extreme weather events, and the carbon transition, the impact that moving to a less carbon-dependent economy will have on many industries. Let's start by looking at the physical risks.
These disasters are becoming more frequent and more severe.
Kristalina Georgieva is the International Monetary Fund's managing director.
Property is affected. Production capacity of agriculture, of industry is affected. Even the very financial institutions may be affected. And what this translates into is a risk for financial stability.
Disasters cost the global economy $146 billion in 2019. Insurers covered $60 billion of that amount. In fact, one of the largest insurance companies in the world, Swiss Re, said that extreme weather events are growing in both number and severity. This means many industries are bracing for even bigger losses in the future. But these losses aren't just lines on a spreadsheet. They impact people like you and me. Tens of millions of people, for example, have been displaced from their homes due to extreme weather. So how could that trigger a financial crisis? Let's look at the fallout that could follow extreme flooding as an example. If the flooding were to happen in a populated area, property would inevitably be damaged or even completely destroyed. It is estimated that 50 to 80% of economic losses caused by natural and man-made catastrophes globally are uninsured. This means an uninsured homeowner who took out a mortgage to purchase the property likely won't be able to pay back their lender. Factor in this happening to many more people, and banks are left without income from mortgage repayments. As a result, lenders might reduce the number of loans they provide or charge more for the service in the form of interest. Prospective homeowners looking to get a mortgage might not be able to do so, and businesses may struggle to get loans to expand their operations. It wouldn't be long before you have an economy grinding to a halt. Although it had a different catalyst, the great financial crisis resulted from banks discovering that investments backed by property had become near worthless, and the ensuing credit crunch caused the global economy to shrink. This is not the only risk facing our financial system. Managing Director Georgieva filled me in.
The world is clear that we have to move from a high to low carbon intensity so we can protect ourselves from rising temperatures and the very disasters I spoke about. But when that happens, industries that are in that area of high intensity become less valuable. Asset valuation changes. And this shift, if it is abrupt, can be quite difficult for financial institutions.
More countries are committing to becoming carbon neutral in the coming decades, meaning they are trying to reduce emissions of CO2 and even capture greenhouse gases from the air. But this transition to carbon neutrality requires many businesses to change how they operate. Let's imagine that an oil-producing company has not changed its business model to focus more on renewable sources of energy. As societies use less gasoline, this firm may lose value. It simply becomes less attractive to investors. If many companies end up losing value because they aren't adjusting to a low-carbon society, then this could eventually spark a market sell-off too.
If this happens without too much preparation, this can cause a kind of a shock to the financial markets. There might be some indirect effects through the connection to the financial system. I mean, even those who might have already decided to invest more in the green financial products. If the financial system overall has a problem, they might also have some losses.
We live in an interconnected world and financial markets span the globe. That's why a tsunami in Japan or wildfires in California could have an impact on the retirement plans of a worker in Italy or on the stocks you bought using platforms like Robinhood and eToro.
One element that could lead investors to adjust their positions in the market is a carbon tax. These levies are being discussed in a wide range of countries and would focus on taxing companies according to their emissions. By making these firms pay more, governments hope that they will be incentivized to pollute less.
If in the coming years governments realize that it is necessary to act quickly in order to reduce emissions, they might decide to increase carbon taxes very quickly within a short period of time. And this will be a problem for those companies that rely too much on gas, oil, coal for their production. And then those banks that have provided loans to these companies might not be in the position to remain stable.
So what can be done to reduce the risks posed by climate change?
The very first and most important thing they need to do is to put in place policies and investments to shift towards the new climate economy, one that is low carbon and climate resilient. But they also need to concentrate on the financial system because it is essential for the functioning of our economies.
In the European Union, governments are working on several measures as they implement the European Green Deal. The plan aims to revitalize economic growth in the bloc whilst reducing the consumption of resources, with a pledge to cut net greenhouse gas emissions to zero by 2050. In addition, the US has also promised to have emissions by 2030 compared with 2005 levels. Japan, Canada, and even China have also announced plans to reduce emissions in the coming years. Central banks, charged with ensuring economic stability, have also started studying how to tackle climate risks in their policies.
Climate change is the biggest challenge we face, but it is also the greatest opportunity of our lifetimes, because managing climate risks is taxing. But the way we do it, by investing in climate resilience and new technologies, offers opportunities for green growth and green jobs.
Investing in a low-carbon society may have wider economic benefits too.
An initial 5% of GDP green investment push, combined with gradually increasing carbon price and attention to those that are affected negatively from a transition. This can be very beneficial for the world economy. It can increase growth by 0.7% on an annual basis over the next 15 years.
Hi everyone, thank you so much for watching. Are you worried about the risks that climate change could pose to your savings?
Okay, so I think one kind of risk that is very evident now, and which is something that will affect you and me, is climate risk. Okay, I think this video provides a good a good discussion of what are the risks related to climate. Essentially, there are two types of risks related to climate that you can think of, right? When climate changes in a way that disasters become more frequent, what you obviously see as the risk is physical risk on businesses. Ano ba yung physical risk of climate change in businesses? If there are more calamities, assets will be destroyed because of calamities. If there are more floods, your warehouse, for example, can be flooded. And if your warehouse is flooded, therefore your inventories are all destroyed. So those are called physical risks kasi lahat sila related to the physical manifestation of climate change, which is a change in weather patterns and a change in weather patterns which results in calamities, natural calamities. There could also be disruptions in supply. Okay, so if you look at physical risks, okay, what was discussed in the video, no? Sabi nila, what happens is because there are physical risks, no, assets may be destroyed. Okay, since asset may be destroyed, its valuation is reduced, value is reduced, and because value is reduced, financial market access is also reduced. Okay, so the risks, there is an event, right, which is the calamity, right? Ang impact niya, the assets may be destroyed, and that is the parang impact, direct impact to the business. Pag nagka-flood, no, or nagka-earthquake or hurricane, na malakas ang hangin, no, it may destroy assets. And when they destroy assets, value is lost. Right? Value is lost. And therefore, there is a loss that's being contemplated upon. Because of climate change, it may destroy assets. That's the event, right? And because of that event, there is a loss that we can expect to materialize if that risk happens. Okay? And the loss might be a direct loss, kasi kung nasira yung asset, di syempre, papagawa mo uli yan. So may direct loss. And there are also indirect losses. Right? What are indirect losses in this case? Access to financial markets. I-appraise na ng mga bangko na lower yung mga assets mo if your assets are in a flood-prone area. And so therefore, nawawalan ka ng access or nababawasan yung access mo sa capital market. So that's an indirect impact of the risk, which is actually also a loss, because if you don't have access to the financial market, no, then your cost of debt should be increasing, right? Because it becomes a more risky transaction. Okay, so here we can see in direct detail, no, or indirectly, that physical risks affect the value of businesses, and since they reduce value, that's something that we should be prepared for, right? The actions that we do so that we can prevent loss is something that businesses should plan for, no? And that is the essence of risk management, right? So what did we do here? What we did here was we identified the risk, right? Right? We estimated the impact, right? And then we are now going to provide or to enact or to spell out plans that would allow us to positively, or not really positively, that will allow us to reduce the impact or eliminate that loss in value completely, if possible. Okay? And that is risk control, or the risk actions that you will take. Right? So, yung physical risk, that is something that's more, I guess, more apparent, no? Mas madaling ma-imagine. But actually, a very significant aspect of climate risk is transition risk, which is transitioning to a green economy. Okay? When a country transitions from a coal-dependent economy to a green economy, what happens? Number one, Of course, there are rules and regulations that will change. No? So halimbawa, in 5 years, pinagbawal yung coal mining, right? Precisely because it is a transition of the country from a coal-dependent economy to a green economy. What is the impact to a business that is a coal mine? Kung coal mine ang business mo, that is a direct impact on your assets value or your business value, right? Because nawala na yung business mo after 5 years, pinagbawal na, right? That risk is called transition risk. And you have identified the trigger. What is the trigger? Change in rules and regulation. What's the impact na pag binagbawal na siya? Syempre, yung asset value mo will be diminished to zero, right? When that happens. So your loss is something that you can determine. From something that's a worthy investment, it becomes a worthless investment once those regulations come in. And so ikaw, since you know that there's a loss, you have to institute a set of action plans to mitigate the risk of changing in rules and regulations because of the transition to a green economy. Okay? So that's the whole risk management process, kung tutuusin, right? You identified the risk, you measured its impact, and you developed action plans on how to mitigate them. So essentially, that's what we'll do for the whole course. Iba-ibang risk nga lang. Okay? What's another transition risk that's worth mentioning and probably more familiar to, say, marketing majors rather than finance majors or finance concentration? Another kind of transition risk is the change in consumer preferences. Okay, what is the change in consumer preferences as a result of the transition to the green economy? Okay, the change in preferences is yung mga bata ngayon or yung mga consumers ngayon puts a premium on something that's organic or something that is sustainably produced. Sustainability. Okay, so there's a change in preferences. So kung ikaw Coke ka, you're a brand manager for Coca-Cola, no? Probably you're not seeing that shift now, but it could happen in the future because part of the transition risk is having a sustainable lifestyle, sustainable whatever, no? So it's something that is worth that might happen in the future. And so therefore, because this is a risk that you have identified, you can be able to measure it through your consumer research, right? Once you have measured it and you've deemed that it is significant, then you can enact risk action plans or risk responses to be able to respond to the risk that you have measured. Okay? So climate risk, even though it's one event, has multiple impacts. And that's what we want to identify in risk management. Okay? So I thought it was a good introduction to what risks are. Okay, risks are uncertainties. Okay, so the traditional definition of risk is that it is an uncertainty concerning the occurrence of a loss. Okay, and this is the more broad definition, meaning pwede mong i-apply sa tao yan, right? So for example, may pera ka, you want to invest it in a bank with time deposit in a bank. No, there's always an uncertainty that that bank may, for example, close and a loss may occur. Right? So that risk is present when you invest in a bank. From an enterprise perspective, risk can be defined not necessarily as a function of loss only, right? From a strategy point of view, okay, risk is defined as the possibility that events will occur and affect the achievement of the strategy and business objectives, which usually pertain to some loss event, essentially. Okay? So from a strategic perspective, risk is any event that will not allow you to achieve the strategy and objectives of the business. Now, those objectives, those business objectives might be financial, they could be not financial. No? But is eventually might have a future financial impact. Okay lang yun. No? Kasi ang goal lang naman is that you define risk as the event that will not allow you to achieve your strategy and business objective. Okay? And those are things that are present in a process called enterprise risk management. Okay? So next we define what an objective risk is. Objective risk is the degree of risk. It's defined as the relative variation of actual loss from expected loss. Ibig lang yan sabihin, may expectation ka na ng loss. For example, non-collection of receivables. Diba, may estimate mo na yan, yung non-collection of receivables based on your previous experience. Okay? However, kung yung previous experience mo, ang average, for example, 90% will not be collected. But in your previous experience, it could be as high as 99% collection or as low as 60% collection. In that case, because of the wide variation, then the actual loss can be the variation in actual loss might be so huge, and therefore there is an objective risk that you are trying to identify now. Okay. You can parang compare that against subjective risk. When you say subjective risk, these are perceived risks. So it depends on the person. The uncertainty is based on a person's mental condition or state of mind and personal analysis. In other words, one's a little bit quantitative with information from previous data points or data set. And subjective risk is based on one person's analysis of a situation. Okay, not necessarily one is more parang tawag dyan, superior than the other. Kasi there are some risks na wala talagang objective. Hindi mo makukuha yung objective risk niya because there's no the variation is so huge that you really cannot fathom it based on historical information. So say the loss from climate risk. Okay, we don't have historical information for that, or binubuo pa lang natin yung historical information on that because yung mga risks na yan nangyayari pa lang past 2 to 3 years na madalas, right? So, but it could be objective if we have more data sets, for example, to work on. Okay. Now, objective probability and subjective probability also needs to be defined. So what's objective probability? It's the long-run relative frequency of an event based on the assumptions of an infinite number of observations. In other words, let's look at an example. It's easier to understand this with an example. So for example, we're looking at Philadelphia and LA. These are not actual data, okay, right? So, for example, in those cities, you have 10,000 homes for Philadelphia and LA. Pwedeng historically, the chance of fire is 1%. And so therefore, your expected number of fires in a year, for example, is 100 fires for both Philadelphia and Los Angeles. However, based on your experience, okay, the range might be so wide, right? So yung average niyan, say, di ba, 100 average niyan, ito rin naman 100 din, right? But the dispersion is wider for Philadelphia, right, than for Los Angeles. And so therefore, Philadelphia in this case has a higher objective risk, okay? Because even though they have the same expectation of risk in terms of number of fires, the variability of result is different, okay? And the higher that variability of result, then the higher is the objective risk, okay? Let's understand some terms first. No, I mean, it's an introductory lecture, so maraming terminologies in this lecture. Okay, first is pure risk and speculative risk. So, what is a pure risk? A pure risk is a risk wherein the only possibilities are loss or no loss. Example here, a good example here is an earthquake. If an earthquake does not happen, you don't gain anything. No, zero, no impact. But if there's an earthquake, definitely there's a loss if it affects your assets. Okay, so ang tawag dyan, pure risk because there's no upside, no, but there's only downsides. Okay? Speculative risk, on the other hand, can result in either profit or loss. There is variability in outcomes, but the outcome might be positive for you or negative. The example here is gambling, but for example, a business example is, for example, prices of inputs. So for example, you are a jewelry maker. Okay, your input is gold. The price of gold is fluctuating in the market, right? You have an expectation of what that price of gold will be. So yun ang lalagay mo sa budget as your price of inputs, right? But eventually, the price of gold may increase or decrease, which may have a positive impact on your expectation or a negative impact versus your expectation. So a situation where either profit or loss is possible. But there is risk because there is variability, there's uncertainty. Okay, so that risk is called a speculative risk. So it needs to be defined because you need to understand that risks have downsides and upsides. Some risks have no upside, pure downside. Some risks have both an upside and a downside. Okay. Next thing that we need to define is diversifiable and undiversifiable risks. If you took 142 already or in finance, you know that what diversifiable and undiversifiable risks are. Okay. Undiversifiable risks are risks that are felt economy-wide. Okay, meaning regardless of what kind of company you are, you will feel the impact of that risk. Okay, so therefore, it's useless to diversify it kasi every asset will be affected by that kind of risk. Say, for example, inflation, or for example, economy. Masama ang economy. GDP has been on a downtrend, for example. Everyone is affected on that, right? Or what the example here is a hurricane. Okay, it's an undiversifiable risk. Pag hinangin yung buong Metro Manila, right? Kahit anong business ka, affected ka, right? So it's economy-wide or large numbers at least, if not the whole economy. Diversifiable risks are risks that are unique to individuals or small groups. Okay? The example here is car theft, but for example, nagtaas ang presyo ng crude oil. Okay? Pag nagtaas ang presyo ng crude oil, what happens in industries where crude oil is an input? Tataas yung input cost niya, right? And because the input costs will increase, profit and loss will decrease, right? There will be a decrease in profit. However, there are companies where crude oil is their output, meaning source of revenues. Okay? And since those companies, revenues niya is crude oil related, no? So therefore, naging mas mahal yung singil niya for crude oil. Kasi siya nag-refine, etc. Therefore, tumaas yung revenues niya. Okay? So, if you combine an investment in those two companies, then those risks sort of cancel each other, right? So, si company A, positive ang impact ng crude oil prices increase. Si company B, negative ang impact ng crude oil prices increase. Okay? If you invest fully in A, edi positive ang impact sa'yo ng risk. If you invest fully in B, then negative yung impact sa'yo ng risk. But if you invest in both, right, in equal amounts, right, then the positive in one is offset by the negative in the other. And therefore, we say that that risk is diversifiable. No? If you diversify your holdings of investments, then some risks will cancel each other and the total risk will be less. Okay? So that's what diversifiable risk is. Next is systemic risk. Systemic is the risk of collapse of an entire system or market due to the failure of a single entity. This is particularly useful or related to the financial crisis of 2007, 2008. No? So that financial crisis is because there was a systemic risk in the asset in that market, in asset-backed securities or mortgage-backed securities, because as mentioned din also in our video, di ba? Biglang naging systemically the value of the mortgaged assets reduced in value all of a sudden. And it became systemic that everyone was affected. And so therefore, one risk can affect a whole system or an entire market. And that's what a systemic risk is. Okay. Now, from a corporate perspective, we talk about enterprise risks or enterprise risks. So it covers major risks faced by businesses. Okay. So under enterprise risks, there are three major types: strategic, operational, and financial risks. So each of these risks might be pure, might be speculative, no? Pero pwedeng strategic din sila, no? So for example, or operational. For example, natural resources, natural calamities pala, na risk. This is an operational risk and at the same time a pure risk, right? Because there's no upside, there's only downsides. Okay? So for example, inflation. For example, input price risk. Okay? So we know that it is a financial risk, but at the same time, it is a speculative risk because there's an upside and a downside for input prices. Okay? So when we talk about strategic risk, it refers to the uncertainty regarding the long run or long-term goals and objectives of a firm. Operational naman deals with the day-to-day activities of a business. Financial risks are risks related to adverse changes in items which affect your profit and loss, which are part of the financial markets. For example, commodity prices, interest rates, forex rates, and the value of money. Okay, what are some examples of this risk? We'll not discuss each of one because that's why there's module 2 for it to be discussed. Strategic risk. What are some examples of strategic risk? Industry risk, economy risk. So industry risk is, for example, merong changes in the makeup of the industry. For example, if merong isang big player na break up into pieces, so the industry makeup changes. So that could be an external factor risk. Economy, competitor, legal, and regulatory risk is also part of external factor. If there are changes in rules and certain laws change which affect your business in a negative way, then that could be a risk that you could check. Okay, another is customer needs and wants risk. Essentially, change in consumer preferences. Okay, that could be a risk, right? Because of some trends, and because of that, revenue will be down, and since revenue will be down, your profit and loss will be down. So therefore, meron ka na agad connection between the risk and the loss. There are some also internal strategic risks like reputational risk, strategic focus, parent company support, and patent trademark protection risk. I'm not going to discuss each risk because we will be going through these risks as we go along, in our class. And so these are just examples. Okay. Next, some examples of operation risks may be related to process. So when you say process, supply chain, customer satisfaction, production or cycle time, process execution. So those are all risks related to operations management. There could also be compliance risk, compliance with environmental laws, compliance with regulation, compliance with policy and procedures, and litigation. Okay? Yung compliance risk, anong kaibahan niya sa legal risk? Yung legal risk kanina, under strategic, legal risk pertains to changes in laws. Compliance risk is your compliance with laws. So pwedeng walang nagbago sa laws pero hindi mo sinusunod. Right? So that is an operations-related risk kasi ikaw lang may kasalanan nun kaya hindi ka sumusunod. Right? So it's an internal issue. So that's why it's operations-related. And those issues might be environmental-related. For example, hindi ka nag-comply sa tinatawag na ECC, Environmental Compliance Certificate. Lahat ng infrastructure projects kailangan ng ECC. At under the ECC, may rules yan. Paano ka makakakuha ng ECC? You cannot start construction without an ECC. So, you have to comply with that environmental requirement. Okay? There are some infrastructure projects na regulatory risk is an issue. Before you implement a project, you need to get regulatory approval. No? If that's the case, then if you don't seek regulatory approval, that's a compliance risk. And of course, one of the more significant risks, in terms of operations are people-related risks. Human resource, turnover, performance incentive, training, related risks. Okay? So you understand why this course is actually a capstone course. No? Sa dulo siya dapat. Right? Because for you to understand operations risk, you have to understand operations management. And you have to understand human resource management. In strategic management, you have to talk about strategy and marketing. No? So understanding all aspects of the business and understanding the risks related to your objectives or to your outputs. What are some examples of finance-related risk? Something related to treasury. Treasury risks are related to how you manage cash. Okay, so when you manage cash, sometimes you borrow. When you borrow, there's interest rate risk because interest rates change over time. Okay. If, for example, you invest your money in foreign exchange, there's forex risk or in foreign currency. Okay. And for example, you're financing a lot of projects, there could be capital availability risk. May project ka nga, wala kang mautangan. Right? So those are all related to the management of cash. Okay. Credit risks refer to collections. Okay. Right? Kasi pag may receivable ka from your customers, you have to ensure that they are collected. Right? What are some risks related to collection? Okay, concentration risk is one. What's concentration risk? Masyado ka na maraming receivable sa isang supplier, sa isang customer. So for example, 10 million ang iyong revenues. You have revenues of 10 million. And for example, the top 2% of customers, they have, for example, 50% of collections. Ibig sabihin, yung top 2% na may pinakamarami kang sales na customer, okay, ang amount in total ng receivables mo from those top 2% customers is equal to 50% of the total revenues or total receivables. That's high risk. There's a lot of concentration risk kasi pag hindi siya nagbayad, wala ka na agad 50% ng collection mo. Right? So that may result in a lot of losses, for you. Okay? Another kind of credit risk is default risk. Hindi nagbayad. The probability of not paying. Okay? Or settlement risk. Magbabayad nga pero ayaw naman magbayad ng buo. Gusto in installments. Right? Or magbabayad nga pero gusto niya ex-deal. So that's settlement risk. Right? So my point is, these are all risks related to cash also, right? And next is trading risk. Okay, essentially this is related to inputs and all those inputs that have an active market. Okay, examples are commodity risk, duration, and measurement risk. Commodity risk, you must familiar kayo siguro, which is the cost of the inputs. Okay. Kasi duration in measurement, medyo technical finance na yan. No? Iwan ko na yan kina Ma'am Ivy for them to discuss in financial risk. Okay? But essentially, these are all related to the management of cash. Yun talaga yung finance-related risks. Okay? Now, risks are not just apparent on an enterprise perspective or for businesses. People and properties have risks or they are called merong sinasabing personal risks. Okay? Personal risks affect not businesses but you as people or us as people and our families. Okay? What are some personal related risks? Okay? Premature death of family head. That is a risk. That's why you have a life insurance. Right? May life insurance na product because gusto mo talagang i-address doon is yung head of the family biglang namatay. And so therefore, may walang continuity in income yung pamilya, right? And that's the risk that's being addressed there. Insufficient income during retirement. Okay, that's why there's a GSIS, SSS that provides that income after retirement or during retirement or after service. Okay, poor health. That's why there's health insurance. Okay, and involuntary unemployment. That's why there's unemployment insurance in other countries. I don't know in the Philippines kung meron, makawala. No? So the point is there are risks that affects people and not businesses. There are also risks that affect your property, so like physical damage, fire, earthquake, etc. So those are called property risk. No? And nasabi ko na ito kanina, there are two types naman of losses. No? There could be direct losses and indirect losses. Okay, so direct losses are the actual physical damage. Indirect losses might be related to foregone income because there is a physical damage. Okay, so those are types of losses. Another kind of personal risk is liability risk, and that is the risk of being held legally liable for bodily injury to damage and also basically legal related risks. Okay, so that legal related risks are significant because usually there's no upper limit with respect to the amount of loss. Kasi depende yan sa judge kung magkano yung i-award niyang losses, no, sa tao na kailangan magbayad. And usually that is not defined by a maximum upper limit. Alien can be placed on your income and financial assets. This is a hold or something that is being foreclosed. So parang naka-pledge, no, yung income and financial assets to cover those liability risks. And legal defense costs can be enormous, no? Pwedeng mahal ang lawyer's cost in the first place. Okay. Now, what are the characteristics of risk? Okay. This one, wala to sa book. I added this. Okay. So when we talk about risk, there are several terms that we need to understand. Okay. Number one is exposure. Okay. For exposure, the key question that you need to answer is what is the maximum amount of damage that will be suffered if some event occurs? Okay. It's not the expected damage, but the maximum amount of damage. Okay. So let's look at this example. Our example is a lender is exposed to the risk that a borrower will default, obviously, right? So pag ikaw ay isang bangko, nagpautang ka sa isang person, that person might not pay you back. There's a risk of default, okay? Or a risk of non-collection. And therefore, the more it lends the bank, the more that the bank lends to the borrower, the more exposed it is. And it is riskier its position is with respect to that borrower. If you are a bank, okay, nagpautang ka kay company A and company B. Company A, for example, nagpautang ka ng 100 million. Company B, nagpautang ka ng 10 million. Okay? Your exposure is higher in company A because you have the maximum damage that non-collection can do to you is 100 million in the case of company A. It's only 10 million in the case of company B. So the exposure is lower for company B. And therefore, the maximum amount of damage might be lower. Okay. Note that the maximum amount of damage is not necessarily the expected damage, right? Because we haven't considered other factors yet. Sinasabi lang nito, kung malaki yung exposure, malaki ang risk, supposed to be. So if you want to manage risk, liitan mo yung exposure. Huwag kang magpautang ng 100 million sa isa lang, right? So probably gawin mo, 10 million lang maximum. Sa mas maraming borrower rather than concentrate the 10 million in one borrower. So concentrate the 100 million to one borrower. Then you are able to reduce the exposure and therefore you're able to reduce the risk. Okay. Exposure measurement is a hard science for some kinds of exposures, especially if it is market driven. Okay? And especially if it's not a pure risk. Okay, halimbawa, risk of fluctuating gold prices. Tapos alahera ka, your business is a jewelry shop. Okay? What is the maximum exposure? Okay? Medyo mas mahirap siyang i-determine kasi market related yung price. Right? I didn't check the price of gold now. So for example, the price of gold is 100 pesos. It could go as low as 0. So it could be as high as what? 2,000? I mean, we don't know that. So the exposures in some risks might be difficult to quantify. However, it might be more mas madaling maintindihan for others. So for example, earthquake. Okay? Tapos ang pinag-iisipan mo ng risk is yung iyong plant. No? Your Procter & Gamble, you're trying to manufacture Pampers, no? Mas madaling malaman yung maximum physical loss from earthquake, right? Tanungin mo lang ang sarili mo, kung nasira to lahat, anong maximum na pwede kong gastusin para buuin uli itong same plant na ito? Right? It's a little bit more, it's a little bit easier because you know that it can be estimated reasonably, right? But for some risks, it might be difficult to do that. Okay. Next characteristic of risk is volatility. Okay. Volatility pertains to the variability of potential outcomes. Okay. We're not talking about probability, no, but the range of potential outcomes, which is related to the objective risk that I talked about a while ago, right? So the wider the potential outcome is, the more risky, no, is that potential source of loss. Okay? So yung example ko kanina sa LA and sa Philadelphia has a wider range of potential outcomes. So therefore fire risk, no, is higher, has a higher volatility in LA, Philadelphia than in LA in our previous example. Okay? Anong example dito? So the number of loans that turn bad is proportionately higher in the credit card business than in commercial real estate. So pareho silang nagpapautang, right? There's some form of collection for a commercial real estate company and for a credit card company. Okay? No? However, pwedeng yung band of the potential outcome of non-collection might be different in a business like a credit card business than a commercial real estate business. Okay? And probably, kasi may kakaiba rin sila ng exposures. Ang commercial real estate, ang loans dyan, say for example, 5 million ang average. Right? So dito naman, credit card debt, say for example, hindi ko alam, say 50,000 lang ang average. Okay? So the exposure might be different. That's why it affects volatility also, yung variability of outcomes. Okay? Next characteristic of risk is probability. So ito na yung chance that it will occur. Okay? Of course, the higher the probability of that risk, then the greater is that risk. Okay? So certain events such as interest rate movements or credit card defaults are so likely that they need to be planned as a matter of course, and mitigation strategies should be integral to the business's regular operations. In other words, the probability might be so often already that it's already part of your budget. Okay? Kasi kung mataas ang probability niya, hindi mo na yan iniintay bago mangyari tsaka kami gagawin. Right? There is already a plan in place because the probability is high and usually the cost of that plan included already in your strategic budget or operational budget. Okay? Now, the higher the probability, then the more risky it is. Definitely, kasi mas nangyayari na siya. Okay? Next is severity. So when we talk about the severity of risk, we're talking about the amount of damage that is actually likely to be suffered. In other words, if you'll imagine it, parang siya na yung expected value, right? So exposure is the maximum. Okay. Probability is the probability or the chance of it happening, right? And then volatility is the parang range of expected outcomes. So bringing them together, no, then you get severity, okay, of a risk. Okay. Of course, the greater the severity of a risk, then the higher is that risk or the more risky that activity is. Okay. So in our video, for example, binanggit na niya yan, right? Because the amount of the loss because of calamities have been increasing historically, and the number of losses have also been increasing in the recent years. Yun yung sabi sa video, right? So the severity of climate risk has been increasing over time. Okay. Next. Another characteristic of risk that is usually not discussed that much is a time horizon. Okay. Some risks have a short duration. Ibig sabihin, maikli lang yung exposure mo in terms of time. Some risks naman, mahaba ang exposure mo when it comes to time. Right? So it also affects whether something is risky or not. Right? If you are exposed to the risk for a longer period, then it is more risky than the same risk that is when you are exposed to a shorter period. So our example here is that when you extend a 10-year loan to the same borrower, okay, has a much greater probability of default than if you extend a 1-year loan. So for example, you're the bank, magpapautang ka kay person A, pwede kang mamili, 10-year loan ba ang ibibigay mo kay person A or 1-year loan. Okay. With this, what is the issue here when it comes to risk and time horizon? If you lend to A for a 10-year loan, then you will be exposed to default risk for 10 years, right? Pero kung 1-year loan lang, you'll be exposed to the default risk of A for only 1 year. So therefore, all in all, mas less ang risk mo, di ba? Kung dito ka sa kabila na 1 year lang yung loan, right? So time horizon can impact your assessment of the severity of the assessment of how risky that item is. Okay. Okay. So for financial risk exposures, usually there's more liquidity in the market, no? So it's easy to reduce or eliminate the risk if it's a short period of time. Okay. Or for example, it's a bond, you're buying a 10-year bond, for example, from a company. If the bond has an active market, meaning pwede mo siyang ibenta sa bond exchanges, then you can effectively shorten the risk of that 5-year bond by selling it in the market. No? For operational risk exposures, the time horizon can be thought of as the time required for the company to recover from an event. Okay? So if it's a critical business activity na biglang nag-bog down because of an event, no, then you can think about time horizon in that case in terms of how long will it take for you to recover and get back on your feet and do your operations again. Okay, that's why there's a lot of there's significant efforts that's being done by organizations to craft what's called business continuity plans. plans or BCP. Okay? Because if you have a business continuity plan, you can reduce the time horizon of the exposure from the risk, right? And so therefore, you can get back on your feet quickly and go and serve your customers quickly. Okay? The BCP plans of companies were tested significantly during the COVID pandemic last year. Okay? All of a sudden, everyone opened their BCP plans. You know, BCP plans or BCPs are not that usually, hindi pinapansin yan in organizations usually. You know, I mean, I've been guilty on that. I mean, I worked in the private sector before. Yung BCP, pag pinapa-update yan, nuisance lang yan. I mean, that's how we think about it then. But all of a sudden, when banks are closed di ba? I mean, during the pandemic, you cannot withdraw anything using the banks, using physical banks or brick and mortar banks. All of a sudden, we had to open our BCPs. Ano nga bang sinabi nating plano natin if the banking system won't work? And so, that will help you shorten your exposure to the time horizon of the risk. Okay? All of a sudden, we had electronic fund transfers. All of a sudden, we had to devise internal control procedures so that we can disburse using EFTs. No? So it was a fun time. Not a fun time for finance people like me. No? But nakakakaba siya, baka hindi ka makabayad, hindi ka makapagpasweldo, right? So we had to open our BCPs finally so that we can operate effectively during the first few months of the pandemic. And another characteristic of risk that is not usually talked about is correlation. Some risks are correlated with each other or negatively correlated with each other, positively or negatively correlated with each other. And if two risks behave similarly, then those risks combined should be high in your priority kasi they amplify each other, right? And so therefore, positively correlated exposures increases the risk of a company than exposures that are negatively correlated because they can offset each other. Okay? An example of a negatively correlated risk, not naman negatively correlated, but at least they offset each other. Okay? What I can think about now is inflation risk. Okay. Technically, if you want to, inflation risk can be fully impact or can fully offset each other, right? Why? Okay. Pag meron kang inflation sa inputs mo, sa iyong raw materials, technically, pwede mong ipasa yan sa output mo. Right? Taasan mo yung prices yung output mo na equal sa inflation in your inputs, right? So when inflation is 4%, for example, costs increase by 4, so that's a negative impact on profits, right? But if you pass it on as part of revenues, then there's a positive impact on revenue, so they offset each other. The inflation risk actually in some industries might not be a big thing, okay? But it might be a big thing if you're, for example, in an industry that is highly competitive, that you're in an industry where price is the name of the game. Pricing is the name of the game. So hindi ka makapag-upward pressure on pricing, on pricing to the customers. Why? Because competition is putting a cap on you, right? And so therefore, in that case, inflation is not negatively correlated, yung revenues and the expense components. Okay. There are some risks naman which amplify each other, right? So, for example, what risks amplify each other? For example, defects. The risk of defects. Okay. So, kung may production ka, you have the risk of defective output. Okay. When you have a defective output, usually it's expensive to rework it. So, there's an input cost that is more expensive. And if that defective output goes to the market, okay, and that defective output goes to the market, napunta sa consumer, tapos na bad trip yung consumer sa'yo because defective yung output, it affects revenues, right? So they amplify each other. If defects goes to the extent that it is distributed to the consumers, then the input cost risk, right, is amplified by the softer demand due to substandard product offerings. So those two are correlated, whether highly or not, we don't know, right? But in my kwento, they are highly correlated. But the point is, some risks amplify each other, some risks cancel each other. And so therefore, that should be part of your analysis. Okay. And lastly is capital. Okay. Risks cost something. Okay, may cost ang risk when it happens. There are losses, right? So therefore, capital also affects the kind of risk that you can absorb. So actually, particularly, this capital here affects your risk appetite. Risk appetite means how much risk can you actually absorb. If you have a lot of capital, marami kang pera, so therefore you can absorb more risks, right? And therefore, you might have more appetite for risk. Rather than for if you're a business with very thin capital, konti na lang ang pera mo, right? So you might be more conservative and therefore affects your appetite for risk. Okay. You need capital because you need to meet the cash requirements of the company. And you also need to cover for unexpected losses of risk exposures. And if you have low capital, then definitely priority mo yung one, di ba? So therefore, konti lang yung pera mo for unexpected losses. And so therefore, with that, your risk-taking will also be affected. Okay? Okay, so those are some characteristics of risk. When you apply these risk concepts to an example, so for example, here, the risk that I mentioned here is the risk of raw materials inventory spoilage, no, due to warmer weather. Okay? So dahil mainit ang panahon, mas mabilis ma-spoil ang inputs mo. So for example, titinda ka ng, I don't know, ano ba? Ano ba magandang itinda na madaling ma-spoil? Buko pie, for example. Okay? That's your output. Definitely, your raw material is buko. And probably because of the warmer weather, mas mabadali silang ma-spoil. Okay? What's your exposure to this risk? Okay? Exposure is the maximum amount of the risk. So the maximum exposure is the total inventories you have on hand. For example, that is 2 million pesos. So that's the total exposure that you have. That's the total inventories that I have. Hindi naman sila lahat masuspoil. But definitely some of them will, but it could be to the extent that all of them will get spoiled. So that's the maximum exposure. Second, variability in loss outcomes. For example, you knew that the spoilage can range from 2% to 15% of inventory levels. So your spoilage can be as low as 40,000, which is 2% of 2 million, or as high as 300,000, which is 15% of 2 million. So that's your volatility or the range of outcomes. Lastly is probability. That's the chance of loss. So there's a chance that it's 2%. There's a chance that it's 3%, 4%, right? So in this case, simple na lang siya. So your chance of loss is this one. So 2% ang chance, and pag 2% daw ang chance, 20% yung probability that the spoilage is 2%, 50% yung probability that the spoilage is 10%, 30% yung probability that the spoilage is 15%. Now, the severity is the expected loss. So you simply get the expected values. So this is the first one, 20% probability na 2% ang spoilage, which is 2% of 2 million. 50% times 10% of 2 million, and 30% times 15% of 2 million. And so that's your severity. Okay. So time period, for example, nangyayari lang to because there is El Nino. So that's the period of loss where the period where the loss is persisting. Okay, so in this case, 1 year lang kasi El Nino season, for example, ngayon. Okay. Lastly, correlation. Okay. This risk might be positively correlated with some. So risk of defects in production, kung spoiled ang input, may defects in production. Okay. Positively correlated with product non-conformity, which may impact consumer demand. Pag may lumabas na panis na buko, no, negative ang impact sa demand, right? So the risk is the presence of the risk is positively correlated with the reduction in demand. Okay? Negatively correlated with input price risk, for example. Kasi pwedeng meron kayong usapan ng supplier mo, pag panis, i-indemnify mo ako, ha? Right? So if it guarantees a certain band of temperature where the raw materials maintain freshness, then there could be some mitigation measures. So ang point lang, i-identify saan may correlation yung iyong risk. Okay? Whether that is statistical correlation or business lang, business sense. Right? That it will affect this much. It will also affect this activity and that activity. Okay? So what is the burden of risk in society? Okay? In the absence of insurance, individuals and business firms would have to maintain a large emergency funds to pay for expected losses. You have to have a lot of standby capital so that you can mitigate losses. And standby capital is not productive. Hindi kumikita ang standby capital. You should be able to invest it, right? That's why funding is required, is good, right? But kung nandyan lang yung pera para for anticipation of a loss that might not happen, it's not productive, no? And therefore, the level of risk affects the productivity of investments. Okay. Of course, risk causes worry and fear. No? Risk and liability lawsuit may discourage innovation, etc. Right? The point here is, if we do not manage risks, the economy will not be efficient, the economy will not be productive. And so therefore, it gives you the importance of risk management. Okay. Managing risk is not just having enough funding on board so that that funding can pay for the risk when it happens. Okay? Risk management is a process so that you can reduce risk to a minimum, right? And with that risk reduction, then yun na lang yung lalagyan mo ng capital, no, sa iyong risk capital, or the one that you will have to set buffers for. Okay. So that's why that's what risks are, and that's why risk management is important. It makes for a productive economy by making sure that capital is deployed in the best way that it should be deployed. Okay, which is in investments, more in investments than in anticipation of risks that may not happen. Okay. So that's an introduction to risk. Next section, we'll talk about insurance. So this is a quick lang because most of the coverage and insurance will be covered in the third module. So what is insurance? Insurance is the pooling of fortuitous losses by transfer of such risk to the insurers who agree to indemnify insureds of such losses. So I highlighted several terms there. So when we talk about insurance, we are pooling risks. Risk is the fortuitous loss. Okay? How do we pool risks? Pool as in pinagsasama-sama. No? How do we pool those risks? Those risks are transferred to insurers. Okay? Who agree to indemnify? What is the meaning of indemnify? Magbayad. No? Ang bayaran ng mga insured, kung sino yung in-insure, okay, for such losses. Okay? So, in essence, an insurer, what does an insurer do? It pools risk. Okay? Ano ibig sabihin ng pool ng risk? Pupunta siya kay company A. O company A, meron kang fire risk dyan, di ba? Okay? Why don't you get an insurance from me? Okay? And pay me a premium, and I will insure your building from fire. So pag nagka-fire ka, right, babayaran kita equal to the indemnification that we agreed. Okay? kung si A lang ang kausap niya, hindi pooling 'yun. Isa lang ang pinul niya. So kailangan niya mag-pool ng maraming tao. Okay? So that he can pool the fire risk of all of these people. And by pooling those risks together, marami na siyang risk. Marami na siyang hinuhold na fire risk. Pero alam naman niya hindi mangyayari yung fire sa lahat ng yan eh. Right? Meron lang possibility na may isa, dalawa, tatlo na mangyayaring fire. No? And so therefore, kung mag-pool siya ng mas maraming risk, bumababa yung incidence ng fire sa total set. Okay? And from there, doon siya nag-make ng money out of it. Kasi hindi naman niya babayaran talaga si A, B, N to N or to Z. Hindi naman sila lahat babayaran over a period of time. Meron lang possibility on some of them. No? And by pooling them together, then I'm able to predict better kung ilang percent yung masusunugan, and therefore I can make a business out of it, right? Because I receive premium, the premium that I get, I can invest, right? And the payments naman is not equal to all premiums, okay? So essentially, that's what the insurance, that's what insurers do, in plain words, okay? So when we talk about pooling of losses, it means pooling, or we want to spread losses by the few over the entire group. Okay, that's what we are trying to do. And risk reduction is based on the law of large numbers. So that's a mathematical law or statistical law. No, as you pool more units together or pool more risks together, okay, kung mas nagiging representative siya ng lahat ng occurrences, no, of potential occurrences of the fire as you pool more units together. Okay, so there should be a large number of similar but not identical exposure units that are subject to the same peril. Okay, kung nag-pool ka nga ng maraming risk pero yung lahat ng risk na yan magkakatabing building, pag nasunog yung isa, nasunog na rin lahat. So hindi mo rin sufficiently na diversify yung iyong risk exposures. So the idea behind pooling is to diversify those risk exposures. So there's a payment for a fortuitous loss. Okay, so dapat may nangyari, may loss, and there's going to be an indemnification by the insurer of that amount that is lost. Okay, essentially what happens in an insurance is a risk transfer. Okay, for a premium, you transfer the risk to the insurer. Kung wala kang insurance, anong mangyayari? Kung wala kang insurance, ikaw ang papagawa niyan ng sarili mong pera. Right? Kung meron kang insurance, ikaw pa rin magpapagawa niyan. Kailangan namang yung insurer ang magtayo niyan for you, di ba? Ikaw pa rin ang magpapagawa niyan, but, right, you will have cash. They will indemnify you for that loss. Right? And you can use that cash para pagawa ulit. Right? So there's a mitigation, right, to the risk that you experienced. Okay? So risk reduction in this case is based on the law of large numbers, as I mentioned. So the greater the number of exposures, the more closely will the actual results approach the probable results that are expected from an infinite number of exposures. Basically, pag pinadami mo siya, mas nagiging predictable yung outcome. Okay? Now, example of pooling of risks, for example, two business owners own identical buildings and they're both valued $50,000. Kung hindi sila magpo-pool ng risks, okay? And for example, 10%, there's a chance that the building will be destroyed in a peril, and therefore 90% is the chance that it will not be destroyed. Okay? So if hindi sila mag-insure or mag-pool ng kanilang risk, what is the expected loss? Expected loss in this case is 90% times 0. 90% times 0. Okay? Probability times the loss. Hindi nasira eh. Right? The probability that it's going to be destroyed is 10% times the amount that will be destroyed, 50,000, which is the amount of the building. Okay, and therefore the expected loss is 5,000. If you get the standard deviation, it's 15,000. Okay, so that's probability times the difference from the mean squared, or from the expected value rather squared. Then probability times the difference from expected value squared. So 15,000. So their severity is 5,000. No, their standard deviation is 15,000. What if what they did was to pool the risks together? If instead the owners combined their loss exposures, okay, and each agrees to pay an equal share of any loss that might occur, regardless kung kanino yon. Okay? So rather than nangyari is, meron na nga yung dalawang building, si A at saka si B. 50,000 worth, 50,000 worth. Okay? So there are two buildings. And what's the probability that neither building is destroyed? Edi 90% for building A, 90% for building B, assuming they're independent events. Okay? And therefore, the joint probability there is 81%. And what is the loss? 0. Okay? Kasi it's not destroyed. What's the probability that the first building is destroyed and the second building no loss or not destroyed? What's the probability of the first building being destroyed? 10%. Right? The second building, no loss or not destroyed, 90%. So therefore, the joint probability of those two events is 9% or 0.09. What is the loss? The loss is 25,000 per person. Correct? 25,000 is because one building is worth 50,000 and they agree to equally share it. Okay? Now, pag baliktad naman, first building no loss, second building destroyed, 90% that the first building will not be lost or will not be destroyed. 10% probability that the second building is destroyed. So that's 9% probability with loss equal to ganun din. Isa lang ang nasira, so 50,000 and they equally share it. So that's 25,000. If both buildings are destroyed, that's 10% times 10%. So 1% joint probability of those two happening. With loss, total loss is 100,000 kasi two buildings yung nasira. They agree to equally share it. So 50,000 yung share ng isa. If you look at the expected loss here, it's the same, 5,000. However, when you compute the standard deviation, it's lower, 10,607, which implies there's lower risk if you pull those risks together. Okay, and that's the essence of insurance. Imagine if they can find so many more buildings and combine it together. Okay, so from the point of view of the insurer, which aggregates the risks together, okay, the standard deviation will be much, much lower than if they are dealing with those risks alone. Okay, so essentially, that's the general concept of insurance and why there's a market for it. So what are the characteristics of an ideally insurable risk? Okay, of course, there has to be large number of exposure units. Dapat marami sila. Like fire, like health insurance, like life insurance. Maraming tao may kailangan ng healthcare costs or healthcare cost subsidies. And so therefore, get a lot of people to sign up for it. It reduces the total risk from when you pull them together. Okay. It has to be accidental and unintentional because we want to ensure its randomness. If it's not unintentional, meaning intentional, so that's called insurance fraud. So therefore, hindi na valid yung randomness assumption. May bias na sa numbers. May bias na sa outcomes. And so therefore, your assumption of the risk might not hold anymore. Okay. Third, the loss is determinable and measurable. Should be easy to determine it. Okay. Last, the chance of loss can also be calculated. Okay, meaning there's sufficient frequency for that you can go by. So for example, if you're an insurer for health, for example, may mga or life insurance pala, meron ka ng mga actuarial calculations or meron ka ng actuarial assumptions which leads you to believe that this is the chance of loss, right? And it comes from your database. Meron ka ng data on all of that. Okay. Next is no catastrophic loss, right? Means there's no single event that's too big for everyone to bear. So that's why usually may mga maximum amounts yan, di ba? Na pwedeng i-insure. No? Because that's to ensure that there's no catastrophic loss. Also, you need to ensure that there's economically feasible premium. No? Economically feasible premium simply says that people can afford to purchase the policy. Okay, otherwise, kasi baka yung premium na ma-compute is so big na wala namang may gustong bumili. Right? So it has to be feasible that someone might be willing to buy at that price. So based on these requirements, most personal, property, and liability risks can be assured. However, market, financial, production, political risks are usually uninsured or difficult to insure. Okay? For market risk, financial risk, even for production risk, I think ang issue dyan is yung determinable and measurable loss. Okay? Sometimes it's difficult to determine the losses for these kinds of markets, or no catastrophic loss. In financial markets, for example, the loss can be so big because there is no upper limit. Right? There's no upper limit for financial risk. So for example, stock price. Okay, well, sometimes may lower limit pala. Zero ang lower limit. Diba? Pero yung dive niya, for example, ang stock price mo, 19. Siyempre, ang lower limit niya, 0. Pero yung dive from 19 to 0 is catastrophic. It's so big of a loss that hindi worth it na isama siya sa pool. Okay? Right? So, something like that. Okay? Political risks naman are difficult to insure, I think, basically because the calculable chance of loss, wala masyado. Political risk is the risk na papakailaman ka ng gobyerno in your operations. It's difficult to calculate that chance, right? Per administration, it might change. Per time period, it might change. And there's really no way to calculate that. Subjective yan, subjective measurement of the risk, right? So we'll skip this. You can just read this. Some differences or distinctions, insurance versus gambling and hedging. Insurance handles an already existing pure risk, and it's always socially productive. Let's contrast that with gambling. Gambling usually deals with speculative risk. Kasi kung puro downside lang yan, ba't ka magagamble kung puro downside? Diba? So there has to be an upside. However, the upside in gambling is that it's a zero-sum game. Okay? When someone wins, okay, it comes at the expense of a loser. So in total, the economy is preserved, right? In insurance, both parties have a common interest to prevent the loss, right? By both parties, the insurer and the insured. Okay? So they're all under a common interest to prevent the loss, and therefore becomes an engine for economic activity, right? And therefore it is more socially productive. Insurance versus hedging. Hedging are risk transfers by contract. Okay, so if you have third derivatives, for example, those are hedging instruments. Okay. And usually hedging is done for risks that are typically uninsurable. So yung sinabi ko kaninang financial risk, saka yung sinabi ko kaninang market risks, usually this can be hedged rather than insured. Okay? Because hindi eksaktong pwede yung business model ng insurance for these kinds of risks. Okay, you'll probably learn more about this during the session on financial risk. Okay. Fewer problems of moral hazard and adverse selection for entities who buy and sell futures contracts You'll deal with this more under financial risk. Okay. For insurance, it's also transferred by contract and for pure insurable risks. Okay. But there are moral hazard and adverse selection issues. Okay. In other words, okay, there could be some sort of fraud involved in insurers. Diba? I'm sure narinig nyo, for example, sa mga movies, may pinatay para makuha yung insurance, diba? So that's part of those risks, right? Because those risks are not random. Hindi sila random nangyari, but intentional. So therefore, there's some fraud related to it, and that is the issues. That's one issue with insurance. Okay. All right. So we end. Okay, may 2 slides pa pala before we end. Okay. In terms of types of insurance, there are 2 types, no? Private and social. Private insurance are insurance related to health, property, and liability insurances. Government insurance refers to social insurance programs. So if you've heard about GSIS, SSS, those are government insurance programs. Private insurance are insurance that you can buy. So car, third-party liability, what else? Life, those are all private insurance because they are private transactions. I mean, you can acquire them through private transactions. So government insurance are social insurance, just like Social Security, unemployment, workers' compensation. So you'll learn more about these things in the last module. Okay. All right. Costs and benefits of insurance, meron pa pala. Okay. What are the benefits of insurance? Of course, indemnification for loss, reduction of worry and fear. In other words, less na alalahanin. Okay. Another benefit of insurance in the greater scheme of things is that it's a source of investment funds. It is a source of funding in the economy. Okay. Remember, they collect premium, right? Yung premium, pwede nilang gastusin on their own, right? But at the same time, those premium, pwede rin nilang i-invest. And usually, insurance companies are a source of financing for companies. Pwedeng mangutang yung companies sa mga insurers. Pwede rin silang, yung mga insurers, pwede rin mag-invest in the equity of companies. So that's why it's also beneficial because it allows for recycling of funds, because they can act as investment funds. Okay. Obviously, loss prevention and enhancement of credit, which are all in essence reducing the losses with respect to the risks that they try to insure. Of course, it is a cost of doing business. There's premium that you have to pay. Okay. And that should be part of the total cost of doing business. So dapat the cost of the insurance premium is enough versus the benefits that we expect from it. Lastly, costs are fraudulent and inflated claims, which are all related to, syempre, pwedeng madaya rin, and therefore might not result to an efficient administration of insurance. Okay.